This is your first quarter market report for 2023.
Finally!
I know it's been a while, but I'm busy, so moving forward, I'll be doing these market reports every quarter. We will review and analyze what happened during the first quarter of this year, specifically for the downtown Toronto condo rental and sales market. But before we get into the nitty-gritty, in our last video, we played the Price is Right to guess the median rent and sales price for the end of January. How did you guys end up doing? I was lucky enough to come in first place by guessing the exact median price for sale and was off by $50 on the rental median price. But I can't win at my own game, so there was a tie between a disciple and Ren. So congratulations. If you want to understand the rules and how to play, watch the start of my last market report video or look in the description of this video below. Leave your answers in the comments below. This will be a good time to hit the like, subscribe, and bell button to be notified of the next video. Now let's get into this month's numbers. The current supply in the downtown Toronto condo market is 1,043 units. Compared to the same time last year, this was a 25% increase. The inventory dropped steeply in December, which is typical for that time of the year. Then started climbing in January, but then did the zigzag motion as the market couldn't really make up its mind which direction it wanted to go. We had a big drop in listings compared to last week, as you can see here. So it seems like currently there is more demand than new listings coming to market. The current inventory is on the higher side, as the previous 6 years had a lot less inventory. I'm watching this carefully because if inventory starts to build, then it's going to put downward pressure on the prices. Now let's take a look at the demand side. We had a really slow start to the year as we saw a significant drop in demand as there was a lot of uncertainty regarding the interest rates. However, since the Bank of Canada paused their rate hikes, the market has bounced back. Although we are seeing an increased demand, it's not as strong as it was in the previous years. There were 491 sales so far this March, and could end up at around 580 if all the deals currently sold conditional go firm. This is not a surprise given the high interest rate environment, so I would conclude that it's a relatively normalized market now, as buyers are out buying again. This graph shows a weekly sales volume since January 1st, 2022. You can see that we are off to a much slower start compared to last year. Also, you can see that sales have been decreasing since the Bank of Canada started aggressively raising interest rates starting on March 2nd, 2022. The Bank of Canada paused their rate hikes on March 8, 2023, so I believe this has brought back some stability to the market, so pent-up demand is being released to the market, which we're seeing in the increased sales numbers. Now let's take a look at another demand indicator, the list price sales price ratio. It bottomed out in January and has since climbed to 100.82% in March. This means on average condos are selling for more than the asking price, as we have been seeing bidding wars happening. Now let's look at the final demand measure we track, the average listing days on market. As you can see, it peaked in January at 30 days. Now in March, it's just over 20 days on the market. Properties are selling at close to the asking price or more, as we are starting to see bidding wars happening on good properties that are priced well. In fact, 28% of the properties sold in March were sold over the asking price. At the same time, listings are sitting on the market for a lot less time than they used to, which is a good indication that the market is picking up. Buyers are still sensitive to the pricing these days, but if you have a good property and are priced well, you can attract a bidding war. Now let's look at the median price since it's the most stable of the three. In March, the median price was $710,000. This was a 4.3% increase compared to last month, but a 9% drop from the all-time high in February of 2022. Compared to last year, it's only a drop of 8.7%. It bottomed out in January at $670,000 and has since been on an upward trend. Here's a graph showing all three prices together. You can see that the blue line, the average price, is relatively flat, and the purple line, the HPI, is on an upward trend. Again, the most stable price metric, in my opinion, is the green line, median price. So we will be only looking at this metric moving forward. Here's a chart of all the unit types broken down. You can see that the prices are quite similar to where they were in March of 2021. The start of this year was really slow as the Bank of Canada was still hiking interest rates, but the saving grace was the fact that the listing inventory didn't spike and was kept relatively low. We didn't see the panic selling as we did in 2020, so this kept prices in check, although they were falling because of the drop in demand. As soon as the Bank of Canada indicated that they were stopping their rate hikes, and actually did stop, we saw confidence come back into the market as buyers started buying again. With the rate hike freeze, we saw that sales have somewhat normalized given the current high interest rate environment. We are definitely seeing an increase in activity as all the demand indicators are pointing to a more active marketplace, so it'll be interesting to monitor what happens during the next quarter, as there is still a lot of uncertainty in the economy. On January 25th, the Bank of Canada raised rates by 0.25%, making it the 8th time they raised rates. Then they held the rate on March 8, 2023, indicating a pause to the rate hiking cycle. Their next meeting is on April 12, 2023, and is expected to hold the current rates, which will most likely bring more confidence to buyers as the rate hikes are over. My guess for the median price at the end of June 2023, at the end of the second quarter, will be $695,000. I guess that we'll see an uptick in the prices in the short term, but it'll start to come back down as more listings come onto the market and more people feel the burden of the higher interest rates. Now let's dig into the rental market. There are 1,695 active rental listings on the market. There's a drop of only 3% compared to last year. As you can see from this cluster here, inventory has been dropping. Here's the current distribution of rental listings. You'll see where most of the active listings sit from this graph. Now let's see how the demand is doing by looking at the leased units. We had a slow start, as is typical for January and February, as people don't like to move in the cold. It's since climbed to 1,785 leases completed in March, which is a drop of about 8.6% compared to last year. However, this is still relatively high compared to the past 7 years. You can see from the weekly distribution that the demand falls as we head into the winter months and starts to pick up in the spring. We should see more demand as we start heading into the second quarter of this year into the peak summer months. Now let's look at the list price rent price ratio, another demand indicator. It was relatively flat for the past few months. In March, it was 99.99%, meaning properties are renting for pretty much their asking price. Now let's look at the average listing days on market. This too has been relatively flat for the past few months and is slightly on a downward trend. For March, it was 18.5 days. The average price has been flat for the past few months. The average price for March was $2,858, down from the record high of $2,973. Compared to last year, it's up by 13.8%. The median price has been the exact same for the past 4 months at $2,600, which is down from the record high of $2,700. And compared to last year, it's still up by 13%. Here's a table of rents across different condo types. You can see all prices are up significantly compared to the previous years. The rents have been flat for the past quarter as we saw a drop in the demand during the slower months, with inventory building up slow enough to keep the prices in check. It seems like now the rental supply is starting to go down, indicating that there is more demand than new listings coming on the market. However, there are a few big condo projects taking occupancy soon, so this should help provide much needed inventory to the market. As we head into the spring and summer months, we should see the demand increase, and if the inventory levels drop, we will start seeing the prices start going up again. However, I know there are a few large projects completing this year, so that will help alleviate some of the pressure. So given all this data, my guess for the median rent price at the end of June 2023 will be $2,650. Finally, let's see what's happening in the investment potential of condos by looking at the median PR ratio. The current median PR ratio is 22.76, and it's trending upwards, making the investment potential less attractive than before. The higher the PR ratio, the less real estate becomes attractive as an investment vehicle. So what this number means is that if you were to pay cash for a condo and divide it by the yearly rent, you'll get 22.76 using the median price and rent. It's similar to the PE ratio for stocks. In summary, I was wrong in my last video that I expected the prices would continue on a steady decline because they are actually starting to go up again. This is why I believe, and let me make this clear, that any future predictions I make are based on probabilities and never certainty, as it's impossible to predict the future as there are just too many unknown variables. In addition, I would consider myself more conservative as I always underestimate the resilience of the Toronto market. So remember this about me and take anything that seems like a prediction from me or from anyone else for that matter, claiming to be an expert, with a grain of salt, because the truth is, no one knows. Just like no one knew that the Bank of Canada would raise their interest rates 8 times in a row. Not even the Bank of Canada knew this was coming. Remember this?
Interest rates are very low and they're going to be there for a long time. So we have been unusually clear about the future path for interest rates. If you've got a mortgage or if you're considering to make a major purchase, or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time.
I guess a long time in Bank of Canada terms means a year and a half. The downtown condo market hit its bottom in January and is now on an upward trajectory. Prices have come down from the peak by about 9%, which is significant, but is not anything close to a crash. In my opinion, we didn't see a much larger decline in prices because the supply stayed low. However, I'm cautiously optimistic because I think we're still in the early innings of this game. We saw a significant drop in demand at the start of this quarter, but it seems like it's normalized again as the rate hiking cycle has stopped and inflation is heading down. We are not seeing a huge influx of supply, which is keeping the prices in check. Without an influx of supply, the prices will hold and most likely go up as demand picks up during the spring market. However, there are some significant financial headwinds, and many of the economists and economic indicators are predicting that we're heading into a recession. If we do head into a recession, the prices will fall, so this is why I'm being cautious, although the market is active right now. With the higher interest rates, we will see more financial pressure on households as more Canadians renew their mortgages at higher interest rates. Combine this with inflation and you're left with a country with less disposable income. In addition, many speculators who are approaching closing on the new properties at these higher and unexpected interest rates are being caught swimming naked as the tide goes out. Hundreds of them are trying to assign their units before closing and even selling them at under what they purchased them for. Mark my words, as this problem is going to get worse before it gets better if the interest rates remain high, as many of these buyers were not qualified to buy when they did, and they definitely won't qualify now at these higher rates. This is why we're still early in this process and the worst may be yet to come. I'm hoping I'm wrong on this, but for now, I'll take advantage of the good market conditions we're seeing right now. The thing about housing is that everyone needs a place to live, and the population in Toronto is growing at an incredible rate. We are fortunate to have this growth because without it, we wouldn't be seeing the type of real estate market we have right now. There are always opportunities for those investors who have been wise and patient with their money and stick with the fundamentals that work. Sure, you may miss some opportunities, however, you will never lose all your chips so you can't keep playing the game. Remember that the number one rule in investing is to never lose money. And the number two rule in investing is to never forget rule number one. I'll leave you with these wise words from the legendary investor Warren Buffett. If you want to learn how to do this in real estate, feel free to reach out to me or ask me in the comments below. Don't forget to guess what the median sale and rent prices will be for the end of June 2023. Let's see how well your crystal balls are doing. I would also love to hear your thoughts on the market and where you think we'll be heading. I respond to every comment as soon as I can. I also greatly appreciate those of you who have subscribed and liked my videos. See you in the next video.